Welcome back to the deep dive. If you've even glanced at the charts today, you know we are kicking off December with what was a swift and frankly a surprisingly brutal sell-off.
It really was.
Prices just plunged hard and fast. It capped November with Bitcoin's worst monthly performance in nearly a year, a rough 17.5% loss.
Yeah, a painful end to the month for sure. But, it gives us a really clear mission for today's deep dive.
Right.
We need to look past the surface panic, the flash liquidations, and really connect three critical threads here.
Okay.
First, the macroeconomic signals and the new regulatory headwinds that are coming out of Asia. And then, crucially, we have to measure that powerful, unwavering institutional counter-narrative that is, well, quietly anchoring the market.
And preventing a total collapse, right? The headline fact that just summarizes the pain is so clear. Bitcoin plunged below $86,000 and it was driven by a massive leverage flush. Over $500 million in liquidations. Just gone in 24 hours. I mean, that's not just a dip.
No, that is a systemic cleaning.
Okay, so let's unpack that immediate pain. The move was aggressive. It just ripped right through that psychologically crucial $90,000 mark.
It did. By mid-morning GMT, we were seeing prices around $86,461, with lows even scraping under $85,000.
It's the kind of volatility that makes even, veteran investors take a second look.
Well, from a technical standpoint, breaching $90,000 signaled major damage. It basically confirmed sellers were in control. But you hit on the critical word there.
The leverage flush.
The leverage flush. That $539 million liquidation event, it wiped out over 180,000 traders. It was brutal, but it is necessary. We talk a lot about speculative froth.
Right, that excessive short-term leverage that builds up.
Exactly. And when the price reverses, all those positions get forcefully closed, and it just creates this cascade.
So are you saying that if the market was carrying too much leverage, this massive purge is actually a sign of long-term health?
Precisely. If you look at the funding rates, basically the cost for traders to hold those leveraged long positions, they had been getting really expensive.
Which means the market was skewed too far to one side.
Overwhelmingly skewed to the upside. So this leverage flush, it just resets the entire system. It drains the capital that was betting on an immediate price continuation, and it establishes a much, much firmer base for the next rally. It makes the market less brittle.
And this is where the psychology lands.
Yeah.
The immediate result of all this pain was the fear and greed index plummeting to extreme fear. I think it settled around 20 to 24 out of 100. For anyone listening, why should they care about that index?
Because it captures widespread capitulation. It's a classic contrarian indicator.
Okay.
When that index is pinned to extreme fear, it means almost everyone who could panic has panicked. And historically, these moments often precede potential market bottoms.
So it's when the so-called smart money starts to accumulate.
That's exactly it. It suggests the people left holding are the long-term conviction holders or the smart money just starting to buy at a discount.
But let's be real about the short-term risk. You mentioned those $85,000 lows. If the selling momentum continues, is $80,000 really the floor?
Well, $80,000 is the next significant psychological support, absolutely. But a true breakdown beyond that wouldn't just be liquidations. We'd need to see a shift in long-term conviction metrics.
Like what?
Things like consistent outflows from long-term holder wallets or a sustained drop in the hash rate. For now, the selling is driven by leveraged players and this macro shock. So while $80,000 is a risk, history shows these kinds of dips often lead to rapid V-shaped recoveries once the shock passes.
Okay, so let's talk about those external shocks, because they really did originate pretty clearly in Asia, creating this powerful toxic mix of policy decisions.
The first and maybe the most unexpected shock came from the Bank of Japan, the BOJ.
Right.
Governor Kazuo Ueda gave this unexpectedly hawkish tilt, strongly hinting at a potential December rate hike. He cited wage growth and, sensitivity to foreign exchange.
And this is a huge deal for the global market because of the yen carry trade, right?
Yep.
Can you just quickly break that down for us?
Sure. The yen carry trade is, in essence, borrowing money very cheaply in yen, where interest rates have been near zero forever, and then investing that money in higher-yielding, riskier assets globally.
Like U.S. stocks or
Bitcoin.
Or Bitcoin, exactly. So when the BOJ even suggests they might raise rates, the yen strengthens. That makes the debt more expensive to pay back.
So investors have to unwind those positions?
They're forced to. They sell off their risk assets, including Bitcoin, to repay the loan. It's a massive, systematic deleveraging event that hits the entire global risk environment.
And then compounding that, while Japan was tightening, China was cracking down again.
Yes, the regulatory punch.
Yeah.
The People's Bank of China, the PBOC, reaffirmed its unyielding stance, and they went further than usual this time.
How so?
They explicitly deemed stablecoins like USDT and USDC illegal. The reason they gave was alleged anti-money laundering failures. This just crushes any lingering hope that China might soften its policy.
And the fallout in Hong Kong was immediate. I mean, they've been trying so hard to position themselves as this pro-innovation crypto hub. And this news just completely undermined that. Hong Kong-listed crypto stocks, especially those linked to stablecoins, tumbled by 10 to 15%.
Wow.
It just highlights this unavoidable tension. Hong Kong might have favorable local laws, but the mainland's authority on systemic matters.
Yeah.
Well, it always casts a long, definitive shadow.
Okay. That is a huge wave of quantifiable FUD, as they say, flowing from Asia. Let's take a breath and pivot to the underlying infrastructure. If we just ignore the daily price chart, how are the core fundamentals of the Bitcoin network holding up?
They're holding up with impressive stability. We look at two key metrics here: global hash rate and mining difficulty. Despite the price dip, the global hash rate is still incredibly robust at 1.061 zettahashes per second, and mining difficulty is holding steady at 149.3 terahashes.
And for the listener, can you explain why the stability of that hash rate is maybe more important than it just hitting another record high?
Stability signals network confidence. A high, stable hash rate means a massive amount of computational power is securing the network. Miners are not panicking and powering down their hardware.
So the producers of Bitcoin aren't spooked.
Not at all. It tells us the supply side isn't anticipating some kind of prolonged death spiral. They're actually reinforcing the foundation.
Speaking of foundations, corporate conviction.
Oh.
Strategy Inc. just made a massive financial move that, it just screams long-term confidence.
It really does. They established a new, separate $1.44 billion USD reserve fund.
And this is completely separate from their main Bitcoin stash.
Completely ring-fenced from their core 650,000 Bitcoin, which, by the way, represents 3.1% of the entire Bitcoin supply. They are a major corporate anchor.
And this fund, it gives them a 21-month operational buffer. What does that signal to the market?
It signals strategic defense. It says they think there might be economic volatility for the next year and a half, maybe 2 years. By creating this massive financial moat, they ensure they never have to liquidate any of their core Bitcoin holdings.
So they can ride out any storm without touching the strategic asset.
Exactly. They are financially insulating themselves, and it really raises the bar for corporate risk management in this sector.
And there's an interesting counter-trend here. While Bitcoin was filing, mining stocks actually climbed about 5% in market cap.
That decoupling tells us investors are looking past the spot price. They're betting on operational efficiency. These miners are getting very good at leveraging energy assets, optimizing hardware.
They're becoming real businesses.
They are. Investors believe the miners are robust enough to generate cash flow even if the price stays suppressed. They're investing in the business of mining, not just the assets price.
Okay, now let's switch our focus entirely to traditional finance, because it seems like the fear from Asia is being powerfully offset by this continued, relentless embrace from major Western institutions.
And nothing embodies this more clearly than BlackRock. The success of their iShares Bitcoin Trust, IBIT, is just paramount.
The numbers are staggering.
IBIT is leading in revenue generation, with assets ballooning to nearly $70.7 billion. To put that in perspective, this single Bitcoin ETF is outpacing legacy funds that have been around for decades.
So beyond just being a big number, why does that scale matter so much?
It creates unparalleled liquidity and legitimacy. When assets under management hit these levels, it signals to every corporate treasury, every pension fund, that Bitcoin exposure is now a professional, viable, and profitable product. It transforms Bitcoin from a fringe asset into a recognized, professionally managed asset class.
And for a truly pioneering move, we have to look at a central bank.
Yeah.
The Czech National Bank, the CNB, actually launched a $1 million test portfolio that includes Bitcoin.
This is official curiosity turning into concrete action. Their portfolio is mixing Bitcoin, USD-pegged stablecoins, and something called a tokenized dollar deposit.
So what's a tokenized dollar deposit?
It's basically a traditional bank deposit represented as a token on a blockchain. So they're testing the two poles of the digital asset world simultaneously.
So regulated digital fiat versus decentralized non-sovereign assets.
You got it. And their governor, Ailes Mitchell, noted that Bitcoin has a low correlation to their traditional holdings, likening its utility to gold. This kind of official validation from a national bank is huge. It provides a blueprint for others.
And it directly counters that fear narrative from Asia, encouraging global allocations.
Yeah.
Long term, That has to support a push toward that $100,000 mark.
Absolutely. The institutional commitment is a critical counterweight.
Let's finish by looking for signals that might hint at a recovery. Let's focus on DeFi and the altcoin landscape.
A major contrarian signal we're seeing is the subdued yields on stablecoins in DeFi. Lending rates for things like USDT and USDC are hovering around 4%.
Which is very low. In previous bubbles, those would be much higher, right?
Much higher, 15% or more, reflecting massive borrowing demand to fuel speculative trades.
So low yields mean low speculative froth.
Exactly. It suggests the market isn't overheated. The speculative interest has been washed out by that leverage flush we talked about. This metric is flashing a quiet but potentially powerful bullish signal for Ethereum.
And what happens with Ethereum tends to spill over to Bitcoin.
With their 80 to 90% historical correlation, a strong ETH rally almost always helps bolster Bitcoin prices.
Conversely, while BTC ETFs are dominating, we see altcoins are still hitting these frustrating regulatory hurdles. CoinShares abruptly pulled its U.S. applications for staked Solana, XRP, and Litecoin ETFs.
And this just signals continued regulatory fragmentation. There is just no clear guidance for anything outside of Bitcoin in the U.S. The SEC is clearly still focused on classifying pretty much everything else as potentially problematic.
And what's the unintended consequence of that setback for altcoins?
Well, the delay unintentionally funnels institutional capital. Institutions have regulatory approval for crypto exposure, but if they can't get it through altcoin ETFs, where's that capital go?
Right back into the dominant Bitcoin ETFs.
Exactly, right back into BlackRock's, I bet. So it creates this sort of natural price floor for Bitcoin, reinforcing its dominance as the single safest entry point for traditional finance.
Okay, so let's try to synthesize this chaotic start to December. We've seen this powerful dichotomy.
We really have. On one side, you have severe short-term pain. It's driven by macro regulatory pressures, the BOJ tightening, the PBOC stablecoin attack. But on the other side, you have these robust, long-term fundamentals. The reinforced hash rate, the massive success of IBIT, Strategy Inc.'s huge defense fund.
So what does this all mean for you, the listener, looking forward? We really have two immediate possibilities. The short-term risk certainly points toward a test of $80,000 if that MAC selling accelerates. However, all the signs of capitulation we talked about, the extreme fear index, the healthy leverage flush, those low DeFi yields, they strongly hint that if a positive catalyst emerges, maybe some dovish economic data, we could see a very sharp rebound toward $95,000, and quickly.
And that leads us to the final provocative thought we want to leave you with. It builds directly on those Asian policy decisions. Given the PBOC's explicit, forceful attack on stablecoins assets designed to bridge with fiat currency, will this regulatory pressure actually accelerate Bitcoin's identity shift?
Interesting.
Will it reinforce its status not just as digital gold, but as the only globally viable, non-sovereign digital asset? When national governments decide which digital assets they will and won't tolerate, only Bitcoin, by its very design, seems truly equipped to survive increasingly aggressive national regulations. So, is the regulatory fear ultimately proving the very value proposition of Bitcoin's independence?